Welcome back. On this lecture, we will compare the net profit margin ratio for both Apple and Microsoft. On this slide, we will calculate the net profit margin ratio for Apple. So, what is the net profit margin and why is it important? Well, net profit margin, or net margin for short, shows us how much net income is generated as a percentage of revenues. This is helpful because the net profit margin helps investors determine if the company is generating enough profit from its sales. More importantly, it helps us figure out if the operating costs and overhead costs are being properly managed. Overall, net profit margin is one of the most important indicators of a company's financial health. So, how is this ratio calculated? Well, it's simply calculated by taking income before taxes and dividing that by revenues. Here we have net income of $57.4 billion. And then we have revenues of $274.5 billion. That results in a net profit margin ratio of 20.9%. So what does this mean? Well, this tells us that Apple makes approximately 21% of net margin from its sales. In simple terms, Apple generates around $21 of net income for every $100 of revenues. On this slide, we'll now calculate the net profit margin ratio for Microsoft. First, we'll take net income of $44.3 billion. And then we have revenues here of $143 billion. When we do the math, we get a net profit margin ratio of 31% for Microsoft. So what does this mean, and how does it compare to Apple? Well, this tells us that Microsoft generates 31% of net income as a percentage of revenues. In other words, Microsoft generates $31 of net income for every $100 of sales. When we compare this to Apple, we can see that Microsoft's net profit margin of 31% is much higher than Apple's net profit margin of 20.9%. The main point here is that on the basis of this metric, Microsoft is more profitable than Apple from a net profit margin ratio perspective.